What's up, everyone? It's Caddy with Money Investing. We are going to be talking about one really good growth stock in this video. This is a company that belongs to a sector which I really want to own stock in, but it's just the valuation collectively for the sector hasn't really come down. And that sector is going to be cybersecurity, and the company in question today is going to be none other than Palo Alto Networks, ticker symbol PANW. This company is turning the corner towards profitability, which is exactly why I'm super excited to analyze this company, go over the fundamentals, go over the revenues, the cash flows, the earnings, the valuation, the balance sheet. We'll cover all the basics and, of course, talk a little bit about the intrinsic value, where the stock should really be trading at, and the technical analysis as well. The market cap right now just a little bit over $51 billion for the company, and you'll notice that every single year they've reported losses, but the last couple quarters, they've reported some profitability. So they are certainly turning the corner towards profitability, which is exactly the reason why we should be looking into this stock in more detail now moving forward. So I hope you guys enjoy it and find it helpful. If you do, don't forget to subscribe to the channel and hit that notification bell and drop a like button. That's all I'm asking from you. And the link to our Discord and Patreon is going to be down below if you're interested in joining our money investing community. And of course, get access to all the alerts, ideas, and private videos and a Discord channel with over 3,600 members. So links are going to be down below. The first thing that we are going to look into is their first quarter fiscal year 2023 numbers. So Palo Alto Networks is in a completely different fiscal year than most companies. Their first fiscal quarter for any year is October, November, December. That was actually, excuse me, let me rephrase. Their first quarter for any fiscal year is going to be the months preceding in October. So that's going to be August, September, July, August, September. So that's going to be July, August, September, and then October, November, December is going to be the second quarter of fiscal year 2023, which is what the company is going to be reporting for on Tuesday, which is today, I believe after the markets close. So after the markets close today, Palo Alto Networks is going to be reporting their numbers, but in the first quarter 2023, which again was July, August, September, their total billings were up 27% year over year to $1.75 billion. And then their remaining performance obligations, in other words, RPOs, up 38% to $8.3 billion. We'll talk a little bit about what these numbers mean and give you guys some more context later in the video. But their next gen security measures, ARR, that's their annualized recurring revenue, is now up to over $2 billion. That was up 67% growth, and their total revenue is up 25% up in the first quarter 23, up to $1.5 billion. Operating income on a non-cap basis, $322 million, up 44% year over year, and then EPS, the earnings per share, was up to 83 cents per share, which was 15 cents more than the guidance that they provided. And the adjusted free cash flow, $1.2 billion, and they are looking at becoming GAAP profitable starting for the second consecutive quarter as well, and moving forward in 2023 as well. So total revenue up 25% year over year to over $1.5 billion in the first quarter of fiscal year 23. This number we've already gone over. Next generation security annualized recurring revenue now up to over $2.1 billion. The thing that Palo Alto Networks is really good at is subscription revenue, right? Services. And their subscription revenue makes up majority of the overall revenue, which we'll go over in just a minute. But total billings, they did decline a little bit quarter over quarter, but year over year, they're still up 27%, which is again a phenomenal growth, $1.7 billion. And remaining performance obligations really is something that the companies still need to perform or pretty much provide their services to the existing contracts, existing agreements they have with other businesses. So these are remaining performance obligations. These are obligations that the company has to their performance that are still yet to be performed. And this can also be laid out as some type of a deferred revenue the company may have paid in advance, and Palo Alto Networks not going to realize that revenue until after they've already provided the services for it. So that deferred revenue is going to end up in the balance sheet. We'll talk about that when we talk about the balance sheet later in the video. But RPOs, you'll notice, have consistently gone up more and more companies are want to do business with Palo Alto Networks, and that's getting up to over $8.3 billion, up 38% on a year-over-year basis. Now, this right here is their split between product and subscription revenue. So you can see how 2022 we've got $330 million. That's still decent growth, but most of that growth, 23, 25, 30% growth coming in from subscription and support revenue to over $1.2 billion, and total revenue sitting at over $1.5 billion for the company, and that's obviously a decent growth from same time last year. This is of 3 months ending in October, so okay, they've got even a more weird fiscal year. I apologize, I misspoke earlier. Their fiscal year is actually going to be August, September, October. That's going to be their fiscal year, and then November, December, and January is going to be their second quarter fiscal year 2023, which is what they are going to be reporting for. Yeah, way to do accounting. Like, it's just completely off. It's off from the calendar year. It's off from the month as well. But this is Palo Alto Network. That's how they do their accounting. So, and then when it comes to total gross profit, very good, increase from $866 million to $1.1 billion for the company. Now, this is what really pleases me from Palo Alto Networks business is the operating expenses. They're not actually spending a ton of money on R&D, on sales and marketing, and general administrative expenses, right? And this is one of the reasons why they are able to turn the corner towards profitability. They're not like Roku, Teladoc, Shopify. A lot of companies that we've looked at that are spending just insane amount of money on their operating expenses, but Palo Alto Network is doing it in a nice, steady way. And you can see that R&D only went up from $339 to $371 million. Sales and marketing only went up from $505 to $615 million. And in fact, general administrative expenses went down by about a 4 to 5% from $104 million to under $100 million for the company. And as a result, you'll notice that the total operating expenses were pretty flat. They only went up from $950 to over $1 billion. That was only a $100 million increase on a year-over-year basis. That is phenomenal. That is really, really good in the way that they're scaling up. And even despite this, they're able to grow revenues and their operating profitability, pretty well in the double digits, even though operating expenses are up by a single digit. So that's really good. And as a result, their net income for this quarter was $20 million versus negative loss, or in other words, a loss of $103 million. And again, their net income or earnings per share, obviously positive. And share count has been a little bit higher at 338 million shares. That's going to be on a diluted basis from the company. Now, this right here is going to be the balance sheet. So they are sitting on over $3.7 billion of cash, and then long-term investments sitting at $2 billion. So when you combine these two numbers, they are sitting at well over $5.8 billion of cash, short-term and long-term investments. That is a phenomenal number. Current assets at $5.7 billion and total assets sitting at $12.5 billion. And you'll notice that their current liabilities are going to be sitting at a little bit over $8.1 billion, which is a little bit less. So their current ratio is definitely struggling right now. However, a lot of it is deferred revenue. So that is something that we definitely need to be, talking about. Deferred revenue is, once again, revenue the company has already received, but the services have not yet been provided for that revenue. So this will eventually trickle down to the actual revenue line. This will be the company's revenue that they will realize eventually. So that's already making up for $3.7 billion. And the convertible senior notes, this right here is obviously a debt that the company needs to pay off in the next 12 months because it's under current liabilities. And then, when you take a look at long-term deferred revenue, $3.4 billion, that again is the company's revenue that they've already received, but the performance obligations are due for over a year. And other long-term liabilities are going to be sitting at just under $120 million. So bottom line is that they have plenty of cash available to pay down all of their debt, convertible senior notes, and other long-term liabilities. And the only things that are making that balance sheet look a little bit concerning from a liability standpoint is the deferred revenue, which is again sitting at north of $7 billion for the company on the balance sheet because they've received the revenue, but obviously they can't realize it. It's going to be a liability because these services are still yet to be performed for those companies. So overall, I would say the balance sheet is actually really, really good. Now, this right here is the overall growth from the company. I mean, just fantastic bar graphs. You can see very consistent growth here for revenues, for gross profits, for operating incomes. Obviously been at a loss, but now we're starting to turn the corner, which is exactly why I'm more excited about Palo Alto Networks moving forward. And this right here is going to be the diluted share count. So it's been going up, but not at a significant amount, but definitely going up quite a bit over the years, from 206, 220 million, all the way up to 295, and now sitting at over 338 million shares outstanding. But if you take a look at their guidance, they have guided down a little bit on their share dilution. So gross profit margins at almost 70%. Everything else is negative except for free cash flow margin, which is sitting at over 33%. So that is really good. But again, efficiency, not that great. We're looking at net income margins at negative 2.5%, but eventually we expect that to turn around and the company to become profitable, especially in 2023. And valuation for the company is, I would say, a little bit on the high end, considering that price to sales is actually okay, not that bad at 7.5, 8.5 times sales. But price to earnings, most certainly, considering that we are just turning the corner and the EPS is really, really low and the price is so high, obviously you would expect the company to be trading at a really high price to earnings multiple, which is true on a GAAP basis. On a non-GAAP basis, sitting at 49 to 60, and on a GAAP basis, sitting at 592. So definitely incredibly high at the moment. And then price to cash flow sitting at 19 to 20, which is actually quite reasonable for this company. Now, in the second quarter 2023, which is what they are going to be reporting for tomorrow, they've guided for a revenue of $1.63 to $1.66 billion and an EPS of 76 to 78 cents per share, using 320 to 326 million shares outstanding. And this right here is going to be their fiscal year 2023 entire guidance, $9 to $9.1 billion in total billings. Total revenue expected to grow 25 to 26% at just over 6.8 to just under $7 billion. And the operating margins to be at 19.5 to 20%. EPS to be around 337 to 344. So right off the bat, if you do the analysis, Palo Alto Networks trading at 169, we divide that by the mid guidance, let's say 350. Palo Alto Networks on a forward basis trading at just over 48 times earnings right now, when their earnings are expected to grow at 34 to 37%. So that PEG ratio is actually going to be 48 divided by 37, and it's going to be at 1.29, which is a little bit slightly unfavorable, but it's really not the end of the world because they're able to grow earnings pretty substantially, 34, 37%. So 48 times earnings is actually not that bad, considering that PEG ratio is just slightly above 1. And free cash flow margins at 34.5 and 35.5%. And more importantly, for the entire year, they're expecting to become profitable on a GAAP net income basis, right? So GAAP net income expected to be positive for the entire fiscal year 2023. This right here is going to be the expectations from analysts, and this is some phenomenal growth here. We're looking at 36% growth in 23, 18% growth in 2024, then 19%, 41%, 19%, 32%, 19%. So they've got a very good growth rate lined up moving forward, and growing earnings from $3.43 all the way to $10.80, all the way up to just a little bit under $18 per share for the company once we price those numbers in. So once we plug in those numbers, we get a compounded annual growth rate, or a CAGR, of 25.7% over the next 5 years. And then over the next 9 years, we get a CAGR of about 20%. So we're going to use 25% as a compounded annual growth rate for Palo Alto Networks. So what I've done here is that I've taken into account their 2023 net income of $1.1 billion, share count of 325 million, and an earnings per share of 354, right? That's pretty much what they've guided for on a non-GAAP basis. And of course, that's what the analysts are also expecting in and around those numbers. So I'm going to go with 25% growth here. Discount rate is going to stay up at a 12%, 10% margin of safety. And when it comes to share dilution, I'm actually going to keep this number flat, because I think in the last 10 years, the company has been issuing shares a very, very small amount, say 0.5% or 1% every year. But now moving forward, I think they are looking more towards keeping the share count either stable or better yet, buying back shares moving forward. So I don't know. I'm going to keep that at 0%. So, to kind of keep things normal here. And then when it comes to the price to earnings multiple, I'm not going to give them a 48 times PE multiple, not even going to give them a 50 or 40 or 30. I'm going to give them a more reasonable 25 times PE multiple, keeping that PEG ratio consistent at 1, because the growth rate is going to be 25%. That's at least what the analysts are expecting from this company. And the PE multiple of 25 gives us a PEG ratio of 1. And we get a fair value of 137, just a little bit under $138 per share. and right now the stock's trading at 169. So it really isn't the worst, deal out there, considering that this is a high growth company and it's expected to grow earnings and revenue pretty nicely. This is going to be that earnings growth, and this right here is going to be the revenue growth for the company, expected to grow from 6.9 billion to over 22.5 billion dollars over the years. And this is just very good linear growth, consistent growth that you're seeing from Palo Alto Networks. So it was actually trading at 133 back in January, so like at the beginning of January, and since then it's obviously rallied over 35%, coming down to its lower highs. So this right here is going to be that level to watch. So support really is going to be sitting roughly at around $133 per share. If I want to be a little bit more conservative and not go off of the analyst estimates of 25%, maybe, just maybe I can go with 20%, and that drops down my fair value to 112. That's about the lowest I could see Palo Alto Networks coming down and being a really good deal, in my opinion. And even if you take into account this year's price to earnings at 112 divided by 350, we'd be trading at about a 32 times earnings multiple when the earnings itself are expected to grow at 37%. So this is going to be that sensitivity grid. Again, being a little bit more conservative here with the growth rate, 20% except for the 25% that analysts are expecting, giving them a slightly higher P multiple. We end up at $112 in fair value, and that's going to be somewhere between these two support areas for this company. So it's going to be on my radar. It is going to be a stock that I'm going to be very keen to potentially invest in if and when it comes down to the fair value or even lower than the fair value, because I think the cybersecurity sector is going to be huge over the next few decades, and there's going to be a lot of demand for cybersecurity, and Palo Alto Networks becoming profitable, turning the corner with a great balance sheet and management and consistent growth in revenues and earnings can be a good solid play, but at the right price and at the right valuation. So I hope you guys enjoyed this video, found it helpful. Going to be super excited to learn more about what they report in earnings and revenue, on Tuesday. But let me know your thoughts on this company. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe if you're new. Don't forget to check out the Discord and the Patreon links down in the description below. As always, happy investing, and I'll see you all in the next video.